Good afternoon, and thank you for joining me today for this presentation on the upcoming tax increases for 2013. My name is Erica Pless. I'm the founder of the Pless Law Firm in Saint Petersburg, Florida, and co-author of the book, The Essential Planning Guide to the 2013 Tax Increases. You may have purchased the book with a different title, as you see here, The Annihilation of Wealth 2013. But don't worry, it's the same book. We just changed the title on it, so everything inside is the same. I had the wonderful opportunity to write this book with Mr. Alan Gassman, who you see pictured here. Alan's not here today with the presentation, but I'll be walking you through the presentation. And we wanted to do this just to kind of help everyone and assist you with your understanding of the impending tax increases for 2013. And the tax law is always changing and at times uncertain. At the present moment, we do not know what the future holds as far as taxes are concerned for 2013. The upcoming presidential election will certainly impact the tax rates and the policies that are going to come in 2013. However, we really don't know what's going to happen. And the one thing that we do know is that the Bush tax cuts are set to expire at the end of the year. And if that happens, we are going to see the highest tax rates that we've seen in over a decade. And in addition to the substantial tax increases that will occur due to the Bush tax cuts expiring, there are two new Medicare taxes that are included in the health care law that was passed under President Obama. And the book, as well as this presentation, covers all of those tax increases and what's going to happen. Now, this chart we put together, it kind of summarizes all the upcoming changes for 2013, and you can see how it compares to 2012. For example, in 2012, the long-term capital gain rate is 15%. Next year, it's scheduled to go up to 20%. And we have this new Medicare tax that's imposed on net capital gains. So that's going to make the long-term capital gain rate at 23.8%. And what's even more alarming is the short-term capital gain rate. Now, taxpayers who are in the highest tax bracket are subject to a 35% short-term capital gain rate for 2012. In 2013, that goes up to 39.6%. But don't forget the 3.8 Medicare tax. So you're looking at a 43.4% tax rate on short-term capital gains for taxpayers in that highest tax bracket. And for C corporations, if you're a shareholder of a C corporation, you receive dividends that are taxed at a very favorable rate right now at 15%. But look at 2013. It's going to go up to 39.6%. And we have the 3.8% tax. So that totals a 43.4% tax on your C corporation dividend income. And down here we've summarized the employment taxes. And Medicare tax is split between the employer and employee for a total of a 2.9% tax right now. The Social Security tax right now for employees are only paying a 4.2% tax on wages up to $110,100. Now, employers don't get the benefit of that 2% payroll tax cut holiday. So they still need to pay the 6.2% on the wages up to that $110,000. Well, look at 2013. That payroll tax cut holiday goes away beginning January 1st. So employees are going to be back up to the 6.2%. And Social Security just came out with a new wage base. So the wage base for 2013 is $113,700. So $3,600 of your wages next year are going to be subject to Social Security tax that weren't taxed in 2012. Now, there's been a lot of talk about the estate tax. Currently, the estate tax is imposed at a 35% rate. Next year, that goes up to 55%. And so what are we going to do about all these tax increases? Well, Alan and I put together these planning tips for you. They're included in the book, and we're going to talk about some of them today. I just want to point out a couple while we're on the screen. We've talked about the capital gain rates. So, it may be best to trigger some of that income in 2012, pay a lower tax rate than waiting for 2013 and get hit with that 23.8% tax rate. You may also want to think about deferring some of those medical expenses or charitable contributions to 2013. They're going to be a bigger benefit to you in 2013 rather than in 2012. And something else we're going to talk about today is considering converting a C corporation to an S corporation. And there are some things you got to think about before doing that, but with the 3.8% tax, it may be beneficial for you to do that. And here we've summarized, we put some estimates together on the tax rates for single taxpayers. And what I want to point out to you here is 2012, the lowest tax rate is at 10%. In 2013, there is no 10% bracket. That goes away. So we're going to have, instead of a 10%, we're going to start at 15%. And then it's going to go to 28%, 31%, 36%, and the highest rate at 39.6%. So you're comparing that to this year. The tax brackets are at 10%, 15%, 25%, 28%, 33%, and 35%. Now, obviously, a lot depends on what's going to happen with the presidential election and if Congress, is able to agree on something. And I just want to point out that President Obama, he's proposed to keep the current rates, except he wants to bring back this 36% and the 39.6%. So basically, under his plan, it would stay the same except for people in the high tax brackets. Governor Romney has proposed to extend all of the Bush tax cuts. Okay, and we discussed the capital gains rates. This is really going to be a big issue for a lot of taxpayers. You're going from a 15% rate to a 23.8% rate, as opposed to a 35% rate to a 43.4% rate. So we're going to have to keep a close eye to see what happens if Congress extends that or not. And again, here are just some other quick ideas to think about as far as minimizing these tax increases. Triggering income in 2012 as opposed to 2013. Think about selling those appreciated capital assets now instead of later. Think about doing an installment sale or possibly a like-kind exchange. I think those are going to be a lot more popular in 2013. And when you're thinking about doing your tax planning, keep in mind, this presidential election will affect a lot of tax planning. As for taxpayers in that high tax bracket, President Obama has proposed to exclude the municipal bond interest from taxable income. So, we're thinking about investing in tax-exempt bonds that may change if this proposal is passed. And also, of course, we have the well-publicized Buffett rule, which would require taxpayers with annual incomes exceeding $1 million to pay income taxes at a 30% rate. So these are just proposals, but definitely something to keep in mind. Now, while we're talking about tax increases, we've also got to discuss the deductions and credits that either have expired or are going to expire. And this chart that we've put together kind of summarizes that for you. And I just want to point out a couple things here that we're going to talk about a little bit more. The wonderful AMT tax, the alternative minimum tax. This was enacted in 1969 to prevent wealthy taxpayers from paying little or no tax by utilizing tax loopholes and taking large itemized deductions. So basically what the AMT tax does is it doesn't allow certain taxpayers who have a higher income to take all of those itemized deductions that they would normally be entitled to take. Now, the AMT exemptions are not indexed for inflation. So what has happened in the past is Congress has come in and applied what has become known as the AMT Tax. This increases the exemptions. So for 2011, the exemption was increased. Here you see the numbers: $48,450 for single taxpayers and $74,450 for married joint filers. Congress hasn't come in and put a patch yet. So we are really nervous about that. If they don't come in, we're going to see taxpayers with lower incomes being subject to the AMT tax. And that really is not the way that the law was, the purpose behind it, to hit the middle income. But if they don't come in and put this patch, that's what's going to happen. Okay, and something else to think about here for taxpayers who itemize their deductions. On that Schedule A, for the past 2 years, we haven't been limited in the itemized deductions. But that's coming back in 2013. The itemized deductions are going to be limited by the lesser of 3% of the amount that AGI exceeds certain thresholds, or 80% of the amount of itemized deductions. So this was reduced in the past couple of years, but that's coming back to that full 3%. Okay, so there are two major changes to the Medicare tax that is included in the healthcare law, or better known as Obamacare. And this is something that the Republicans have really come out against and opposed this tax. But it was included in the healthcare law as one way to pay for all the healthcare law changes that are in this act. So there's two changes to it. One is a 0.9% increase to the Medicare tax on employees for wages and net self-employment income for taxpayers whose income exceeds certain thresholds. The other, more expansive change, which we've talked about a little bit, is a 3.8% Medicare tax on net investment income. And again, this only affects taxpayers in the higher tax brackets. But they're both in place. They are going to be effective January 1st, 2013. The 0.9% Medicare tax, this affects taxpayers, married taxpayers, who have wages or net self-employment income of $250,000 or more. For married taxpayers filing a separate return, you're looking at $125,000 and $200,000 for all other taxpayers. The 3.8% tax, again, this affects taxpayers whose income is in the higher categories, $200,000, and we have for the married couple filing jointly $250,000. And this is imposed on the net investment income, and we're going to break that down to tell you exactly what net investment income is. The 3.8% tax, you need to do a calculation here. It's going to be imposed on the lesser of the net investment income or the amount which the modified adjusted gross income exceeds these thresholds. And we're going to give you an example here to make this a little bit easier to understand. So here we have a married couple that's filing a joint return. They have modified adjusted gross income of $500,000. $100,000 of that is net investment income. You're going to think of interest and dividends, okay? They're going to pay the 3.8% Medicare tax on the lesser of either the net investment income of $100,000, or then you got to do another calculation here. It's the modified adjusted gross income of $500,000 minus that threshold. For a married couple filing a joint return, that threshold is $250,000. So we're taking either the lesser of $100,000 or $250,000. Obviously, $100,000 is less. So the 3.8% is going to be imposed on that $100,000. They're going to be subject to a $3,800 Medicare tax bill in 2013. So here we've broken down net investment income. It includes interest, dividends, royalties, income from certain annuities, net rental income, things that are not derived in the ordinary course of trade or business. You're also going to be, your net capital gains are going to be subject to the 3.8% tax. And if you have a trade or business that generates passive activity income, hedge fund income, that's also going to be subject to the 3.8% tax. So you need to think about if you are a shareholder in an S corporation, and if that S corporation receives any passive activity income, that passive activity income is also going to be subject to the 3.8% tax. And here this slide is talking about the hedge funds. When you think about hedge funds, there is a temporary Treasury regulation that says that this income derived from trading investment assets is not considered passive activity, shouldn't be considered passive income for purposes of the 3.8% Medicare tax. That was the thought. However, there is a specific provision in IRC 1411C2 that makes this hedge fund income specifically subject to the 3.8% Medicare tax. So I think the Treasury was expecting this argument, and so they put this specific provision in there, so that income is going to be subject to the 3.8% tax. And also another thing I wanted to just mention is the carried interest. Now that's the income that the hedge fund manager receives for assisting people with their investments. This has been a really hot topic lately, and something that politicians have been discussing a lot, because carried interest is taxed right now at 15%. And there is an argument that says that really should be taxed at ordinary income rates. So we'll have to see what happens with carried interest, but that's also going to be subject to the 3.8% tax. And here we've broken down what is subject to the 3.8% tax and what isn't. Another thing to mention here, if someone sells a personal residence and it qualifies for the exclusion amount in IRC 121, any amount in excess of that exclusion, that is subject to the 3.8% tax. And down here we have things that are excluded from it as well. So what are we going to do about all these tax increases and the 3.8% tax? So Ellen has broken down some points here to think about and what you can do to either avoid it or to minimize the 3.8% tax, and we're going to discuss that in a little bit more detail. You're going to want to think about selling your appreciated capital assets in 2012. And here we have an example of someone who decides to sell the stock in 2012 or waiting until 2013. And according to our calculations here, if this taxpayer waits to sell the stock, whoops, I just went back. Get back to the other slide here. Okay, here we go. Our taxpayer here, Bill, if he waits to sell the stock in 2013, he's going to pay over $111,000 in taxes on the capital gain, as opposed to selling it now in 2012. That's a difference of $36,400. It's certainly an incentive to sell the stock now as opposed to waiting to 2013. Another thing to think about is contributing the maximum amount to your IRAs. If you reduce your modified adjusted gross income below those thresholds, you're not going to be subject to the 3.8% tax. So, that's something to think about here. If we have a married couple who is close to that threshold, they have modified adjusted gross income of $260,000. If they reduce that by $10,000, to contribute that $10,000 to an IRA account, they're going to reduce their modified adjusted gross income below that threshold, and they're not going to be subject to that 3.8% tax. And also something to think about is consider converting your traditional IRA to a Roth IRA. However, before doing this, it's really important to sit down with a qualified tax attorney or your CPA and discuss it. If you decide to convert, you should do that in 2012 because the conversion amount will be included in that modified adjusted gross calculation for purposes of the 3.8% tax. So if you're thinking about doing that, you want to do it now before the end of 2012. Don't wait until 2013 to do that. And think about contributing to deferred compensation plans. For 2012, the limit is $17,000. Next year, that's going up to $17,500. So again, you can reduce your modified adjusted gross income and not be subject to that 3.8% tax. Another great idea is to purchase life insurance policies. Life insurance is a great estate planning vehicle if it's done properly. You can mitigate that 3.8% Medicare tax, and the income that builds up inside that that exceeds the amount of the premiums, if that's not subject to income tax, which life insurance is not, you're not going to be subject to that 3.8% tax. But you need to be careful if you're looking into a policy that is non-qualified annuity. If that exceeds the premiums paid, that's going to be subject to the 3.8% tax. And think about investing in an oil and working gas interest. Individual taxpayers who directly own a working gas interest or whose liability is not limited by holding it in, for example, a limited partnership or a limited liability company, they're not going to be subject to that 3.8% tax. But you want to consult with your attorney before doing that. It's definitely something that you should look at all the issues related to that if you're holding something and you're not protected by some type of limited liability. Think about investing in your tax-exempt bonds. But you want to keep in mind, too, that President Obama's proposal about making the tax-exempt bonds subject to tax. But if that doesn't happen, tax-exempt bonds are going to be a great, great investment for most taxpayers. You're not going to be subject to income tax. You're also going to escape the 3.8% Medicare tax. So definitely something to think about for 2013. If you sell your assets in 2012 and you want to reinvest that money in something, think about doing it with the tax-exempt bonds. And here's another really great idea, a charitable remainder trust. What you can do, a taxpayer can transfer a highly appreciated asset to a charitable remainder trust. In return for that, the taxpayer receives an income or annuity interest for life or for a period of years, and there are certain rules that you have to meet in order to qualify for this. But upon the death of the taxpayer or the expiration of that time period, the remainder interest is transferred to a charitable entity of the taxpayer's choice. Okay, the charitable remainder trust is not subject to that 3.8% tax. So if they sell the asset, they're not going to be subject to that Medicare tax. Now, the one issue that's still kind of open, and we're not 100% sure on the answer right now is if the non-charitable beneficiary, the money that they receive from the trust, if that is going to be subject to the 3.8% tax. That issue is still in the open, and we're not sure how that's going to be handled yet. We're hoping that it's not going to be subject to the 3.8% tax, but we're going to have to wait and see with some more guidance on that issue. Okay, if you are holding a passive, an interest in a passive real estate activity, you're going to want to seriously consider converting that to an active interest. Net rental income is subject to that 3.8% tax unless the taxpayer materially participates in the real estate business. And in order to meet the material participation rules, you're going to want to discuss that with your tax advisor. You're going to also want to limit your triple net leases. Okay, something that we mentioned earlier about converting your C corporations to an S corporations. The C corporations are not as favorable in a lot of cases because they're subject to 2 layers of tax. The corporation at the entity level is subject to tax on its income, and then when it distributes income to its shareholders are also subject to tax. And that's where you hear that phrase, the double tax regime. So in that respect, the S corporations are favored because the S corporation is not taxed at the entity level. The income that the S corporation earns flows through to the shareholders, and the shareholders are the ones that pay the tax at the individual rates. Now, C corporations over the past couple years, the dividends that are sent to the shareholders of the C corporation have been taxed at a favorable 15% rate. However, that's changing for 2013. They're going to be subject to the highest ordinary income tax rate of 39.6%, and in addition, the 3.8% Medicare tax. So here we have an example of if the rates remain the same for corporations in 2013. You have a C corporation with $500,000 in net income. The C corporation will pay $175,000 in income taxes. So there's net $325,000 that's distributed to the shareholder. At the highest tax rate, that taxpayer is going to pay $141,050. So you combine the amount that the C corporation pays in taxes with the amount that the shareholder pays. Of that $500,000, $316,000 is taxes paid. That's a substantial amount of money. It's definitely a reason to think about converting your C corporation to an S corp. And here we have John Smith. He is a shareholder of a C corporation. He earns a salary of $300,000 and receives a dividend of $500,000. He files a joint return with his wife, and we're going to assume that she doesn't earn any income here. We're also going to assume the $300,000 is fully taxable, giving them a modified adjusted gross income of $800,000. The $500,000 dividend is treated as a qualified dividend and taxed at a preferential rate of 15%. This is for 2012. Now in 2013, John's going to pay an additional 0.9% on his wages that exceed $250,000 and an additional 3.8% tax on the $500,000 dividend. That's over $31,000 in FICA taxes on the same amount of income. And you got to remember that if the Bush tax cuts are eliminated, John's going to pay income tax on the dividend at the highest ordinary income tax rate of 39.6%, not the preferential rate of 15%. So this shows why S corporations are going to be favored in 2013. An S corporation shareholder in the highest tax bracket is not going to pay the same amount of taxes that a shareholder of a C corporation is going to have to pay. But there's two other things to consider before you convert a C corporation to an S corp. There's two traps. There's a built-in gains tax and what Alan likes to refer to as a sting tax. These are things to talk with your qualified tax advisor and your CPA about before doing that. Now, if you think about converting your C corporation to an S corporation, the other thing that you need to think about is that any income that the S corporation earns that's considered passive income is going to be subject to the 3.8% tax. So this is why we are telling people to think about converting their triple net lease arrangements to active leases. Become actively involved in your real estate business, and you want to qualify as a real estate professional. For the specific requirements, you're going to want to look at Code Section 469 and the accompanying Treasury regulations. So now we've kind of changed the facts here a little bit. John Smith is a doctor. He has a medical practice that's an S corporation. He earns a salary of $300,000 and receives $500,000 in K-1 income from the S corporation. And again, we're assuming he's married and there's no other income. He is not going to be subject to the 3.8% Medicare tax on the K-1 income in 2013 unless he's a passive investor or the S Corp's profits are comprised of interest, dividends, or other net investment income. John is still going to be subject to the additional 0.9% Medicare tax on the excess wages. But you want to compare this to the previous example where John had the C corporation. He paid $19,000 on the Medicare taxes on the income from the C corp. He doesn't have to pay that for the S corp. Now we're going to change the facts a little bit more. Let's assume that the S corporation's business profits include $100,000 of net rental income from a passive arm's length tenant. The additional 3.8% Medicare tax is going to be imposed on that $100,000 of that K-1 income, even though it's an S corporation. So that's another $3,800. And again, John's going to be subject to the 0.9% additional tax on his wages that exceed the threshold for a married taxpayer filing jointly. Okay, so now we have the S corporation that owns and manages the rental real estate. We have two shareholders, shareholder A and B. One qualifies as a real estate professional, and the other shareholder is just a passive investor. Shareholder A, who qualifies as a real estate professional, is not going to be subject to the additional 3.8% Medicare tax. A's wages in excess of the applicable thresholds will be subject to the 0.9% Medicare tax, but he escapes that 3.8% tax. Unlike the other shareholder we have here, shareholder B, he's not going to be required to pay that 3.8% tax on the $200,000 that's distributed to him. Shareholder B's K-1 income from the S corporation is subject to the additional 3.8% Medicare tax because he does not qualify as a real estate professional. So B is going to pay $8,500 in Medicare taxes in 2013 that A is not going to be subject to paying. And also when we're thinking about business planning, business tax plan, what to do before the end of the year. The Section 179 deductions, we've had some really favorable limits over the past couple of years, as you can see here. 2010, 2011, there was $2 million limit on purchases. And then we had bonus depreciation. Obviously, this was intended to boost the economy, but here it's being reduced again. 2012, the limit on purchases is $560,000. There still is some bonus depreciation, but it's not the 100% that we had in 2011. But look down here at 2013. The 179 deduction limit is $25,000. Your limit on purchase is $200,000. That's a very substantial difference than what we've seen over the past years, and businesses need to be aware of the change. If they haven't maxed out the amount for 2012, they should consider doing that before year end. So here we have an example of 2012. We have taxpayer Tom that purchases an asset for his business. It costs $500,000. He can take a Section 179 deduction of $139,000 and a 50% bonus depreciation of $180,500. If we assume that this asset has a 5-year life, he can also take the normal first-year depreciation of $36,100. Assuming a 35% tax rate, this results in a savings of over $124,000. Now, if Tom waits to purchase this asset in 2013, he's going to be limited to the normal first-year depreciation with no Section 179 deduction or bonus depreciation. The Section 179 deduction will not be available to Tom because the dollar limit on purchases for 2013 is only $200,000. So you need to talk to your clients and make sure that they're aware of this to encourage them to max out their 179 deduction in 2012. Okay, now we're going to briefly touch on the tax increases for trusts and estates. We have the chart here that shows the gradual tax rates for trusts. And you can see here that trusts hit that highest 35% rate at a very low amount of income. And so if a non-grantor trust has $100,000 of income and distributes all of it to the beneficiaries, the trust is not going to pay any tax. The beneficiaries will pay the tax. But if the trust does not distribute the $100,000 and has no other deductions, the trust is going to be subject to a tax of close to $34,000. And trusts and estates are not going to escape the 3.8% tax that's coming. So the tax is going to be imposed on the lesser of the undistributed net investment income of a trust or estate, or the amount by which the AGI exceeds that top inflation-adjusted bracket. We're expecting that to be around $12,000 in 2013. So if a trust has $300,000 of undistributed net investment income, it is going to be subject to the 3.8% Medicare tax on the $288,000. So that is going to equal $10,944 of Medicare taxes that trust has not had to pay in the past. But if the trust distributes $100,000 pro rata to each of its beneficiaries and retains $100,000, it's going to pay the tax, that 3.8% tax on the $100,000 it retains. The beneficiaries are going to be subject to tax on their $100,000 each. So let's look at an example here. Our trust has $300,000 of undistributed net investment income. Again, we have beneficiary A and beneficiary B. Beneficiary A is a single taxpayer with modified adjusted gross income of $150,000. Beneficiary B is married taxpayer and has modified adjusted gross income of $500,000. If beneficiary A has other income exceeding $100,000, he will be subject to the 3.8% Medicare tax on the lesser of the distribution or the amount exceeding $200,000. If beneficiary B is married and files a joint return and has $200,000 of adjusted gross income, beneficiary B and his spouse will pay the Medicare tax on $50,000. That amounts to $1,900. But if beneficiary A does not have other income, he will not be subject to the additional Medicare tax because his modified adjusted gross income does not exceed the $200,000, which is a threshold for a single taxpayer. However, beneficiary B will be subject to the 3.8% Medicare tax on the distribution, and here we have the calculation. You take the lesser of the modified adjusted gross income, which in this case is $500,000. You're going to subtract the threshold for a married filer, which is $250,000. So again, we have $250,000 and the net investment income of $150,000. $150,000 obviously is less than the $250,000, and that's how you're going to calculate the Medicare tax. So trustees in 2013, they're going to have to look at this very closely and very carefully. They're going to have to decide if it makes sense to distribute more income to one beneficiary than another, depending on how they're going to be taxed. And if the trustee decides they're not going to distribute any of the trust income, the trust is going to be subject to that Medicare tax. If the trust here in this case had the $300,000, their trust is going to have to pay that $10,944. And they're going to have to decide, does it make sense to distribute the income pro rata, or, distribute more income to one beneficiary over another beneficiary. And you're also going to have to keep in mind that charitable remainder trust. Alan and I both think that the charitable remainder trusts are going to be extremely popular in 2013. And here we have an example. If you have an appreciated asset and you want to transfer that asset to the charitable remainder trust, how that benefits the taxpayer. The taxpayer is going to receive an income tax charitable deduction, okay, and they're also going to get to offset that for the taxable income in the future years. And here we explain the tax advantages of transferring an asset to a charitable remainder trust. And a charitable remainder trust generally do not pay income taxes. So the taxpayer, when they contribute a highly appreciated asset to the charitable remainder trust, and then the charitable remainder trust sells that asset, they're not going to have to pay the tax on that, on the gain. And the charitable remainder trust, we know, is exempt from the 3.8% Medicare tax. But what we don't know is whether the non-charitable beneficiary is going to have to pay the 3.8% tax on the annuity that they receive from the charitable remainder trust. So it's definitely something to keep in mind, and hopefully that Treasury will come out and give us a little bit of guidance on that issue. So now we've come to the conclusion of the webinar. I want to thank everyone out there for listening and for purchasing the book. It's been a really great experience to work with Alan and everyone at his office to write this book and hopefully help people understand the tax laws a little bit better and plan for the upcoming 2013 tax increases. And keep in mind that the estate tax exemption currently is at $5,120,000. That's going to be reduced to $1 million in 2013. So now is the time to make those large gifts if you have the ability to do it. Establish a charitable remainder trust, or this other concept that Alan came up with, a safe trust. It's definitely a great way for affluent taxpayers to transfer their assets to other family members and escape paying the estate tax on those assets. So again, we thank everyone for joining us, and if you have any questions, comments, or suggestions, please feel free to contact either Alan or myself. Our email addresses and contact information are right here for you. So again, thank you very much.